something fishy is going on with the Indian startups, their valuations and their proceeding IPOs. As soon as I started researching about it, I found out a lot of loopholes and patterns that might end up public's interest in these stocks. But more important, are they scamming you? Hey everyone, this is Udit and Akhouri, and today we would be discussing some serious patterns that I observed in the listed Indian startups and would try to decode whether we are being scammed or not. But first, try to find something common in these companies: Zomato, Vedanta Learning, Nykaa and Paytm. Well, all these companies are Indian startups which got listed in last 18 months. However, there's something more than common in these stocks. You see, all these 4 companies were having some very strong financials at the time of their listing when compared to other privately valued startups at that time. Just think of Unacademy. It was founded in 2015 and in financial year 2021 and 2022, it made over 450 crore rupees and 850 crores in net revenue. This, when compared to its 1500 crore and 2800 crore rupees loss in the same financial years, doesn't look appealing. But remember, these are startups, and as per some experts, it's okay to lose a few hundred crore rupees if you want to play it big. And I really don't have any problem with this, okay? But things slightly change when you compare it with its 3-year-old counterpart. Yes, I am talking about Vedanta Learning. Now, Vedanta caught my eyes just a few days back when my trading platform notified me of buying this stock. And as soon as I looked into its finances, I understood that something is not right. This edtech company claims to be one like Byju's and Unacademy, but unlike them, Vedanta started just 3 years back, and last year it had its IPO. But what's even more uncommon than its baby age is that at the time of their IPO, its revenue suddenly increased by 400%.
Franc, peso, or piaster, dollar, ruble, or yen. If they stop moving, it's disaster till they're moving again. It's gotta circulate, come out of the woods, stimulate, motivate, service and goods. It's no nest egg to incubate, money's got to circulate. Money's gotta circulate.
And then, after they went public, the revenue dropped by over 50% again. To me, this looks somewhat fishy because how on heck can a 3-year-old company making 1 or 2 crore rupees revenue a quarter suddenly increases its revenue to 15 crore and 59 crore in next 2 quarters latest to its IPO, and once the listing is done, half of the revenue crashes, it vanishes.
And it's gone.
And the same pattern is very common and can be observed in multiple startups that has been listed in past 2 years. Think of Delivery, whose quarterly revenue somehow by miracle jumps to over 500% at the time of their IPO and crashes to over 60% just after listing. Or Nykaa, whose quarterly profit increases by over 2400% at the time of their IPO, and then 3/4 of the whole profit vanishes. The exact same pattern can be observed in stocks like Paytm, Zomato and other VC-backed startups that got listed in past 2 years. But now comes the major question. What does this pattern tell us? See, in the first case, it might be a coincidence, and I am literally telling you that I pray this to be true. Because in the second case, things are very fishy. Why? Because this looks like an organized manipulation of financial data from a company's balance sheet just before it applied for an IPO. In my opinion, this can be a classic case of unbearable pressure from the investors and a bad risk management strategy of a company's management that forced them to manipulate this data. Now, you have to understand this. If an investor has given you some X amount of money, it's your duty to give them good return. But how is this return calculated in a loss-making, heavily illiquid startup? Simply through balance sheets. So if a company is growing its revenue by huge numbers, making some profit or decreasing its losses, then you can expect that the company is growing, right? But obviously founders are no god and sometimes number can be dissatisfying. So what do you do as a founder? You start manipulating your financial numbers and start providing altered figures to your private balance sheets. And this happens. Just go and Google, you'll find a lot of examples of companies who recreate and refix and restructure their balance sheet after it is published. Now when these companies become much bigger, quote unquote, in terms of being privately valued, management starts to suggest an exit by filing an IPO. You see, for many non-VC backed ventures, an IPO is a source of raising funds to expand and scale. But for startups like Zomato, it's an exit for investors who don't believe in the company anymore. Investing in such startups through an IPO is like investing in a company whose founders are going on a very long vacation with no plans to come back. So what happens next? These companies do some miraculous sales and risk management in just 2-3 quarters prior to their IPO, and once the listing is done, it all becomes fairy dust. Because in realistic world, no company can attain such huge numbers in a matter of 1-2 quarters, and even if it does, why does it crashes after the listing? Why does the peak revenue / profit quarter coincides with the quarter of its IPO? The answers are hidden in the lines, but if you ask my opinion, I won't risk my money in fulfilling the needs of a manipulative board of a company. So that was the first episode of Behind the Market series, and I will be coming back with such videos very soon. But more importantly, if you want to raise capital from an investor who don't panics you to artificially pump sales and increase numbers, you can pitch me anytime through uditakhouri.live or my investment firm Aim Capital. More details are in description box. Till then, bye-bye.
Why is no one answering the phone? It's Wayne Enterprises, Mr. Earl. I'm sure they'll call back.
Bruce? You're supposed to be dead.
Sorry to disappoint.